You lend your friend your bicycle for the weekend. Simple enough. But what you don't know is that your friend turns around and lends that same bicycle to someone else, who then lends it to a third person who's now riding it across town while you're sitting at home wondering where your bike went. And here's the kicker. On paper, 3 or 4 different people all technically have a legal claim to that one single bicycle. That sounds insane, right? Like something that could never actually happen with real money in a serious financial system. Except it did happen. It happened with billions of dollars. It happened at one of the biggest investment banks on the planet, and when the music stopped, thousands of people found out the hard way that their safe collateral had been quietly recycled so many times that nobody could quite figure out who actually owned what. This is the story of rehypothecation and how Lehman Brothers turned an obscure legal mechanism into a financial house of cards. Before we get to Lehman, let's slow down and actually understand what this word means. Because honestly, the word itself sounds like it was designed to make your eyes glaze over. Rehypothecation. Say it 5 times fast. But strip away the jargon, and it's actually a pretty simple idea. Let's start with the base concept, hypothecation. When you take out a loan and you pledge something as collateral, but you still get to keep using it, that's hypothecation. Think about your car loan. You pledge the car as collateral to the bank, but you still drive it every day. The bank doesn't take physical possession, it just has a legal claim on it if you stop paying. That's hypothecation. Now add the re in front of it. Rehypothecation is when the person holding your collateral, say a bank or a broker, turns around and uses that same collateral for their own borrowing. So now your asset isn't just backing your loan, it's also backing someone else's loan. Your collateral is working 2 jobs at once, and you often don't even know it. This isn't some shady back alley scheme, by the way. It's baked right into how modern Wall Street works, especially in something called prime brokerage. Here's how it usually goes. A hedge fund wants to make big leverage bets in the market. It doesn't have unlimited cash lying around, so it goes to a prime broker, a big investment bank, and borrows money or securities to make those trades. In exchange, the hedge fund pledges its own securities as collateral. Totally normal so far. But here's where it gets interesting. The prime broker doesn't just let that collateral sit in a vault gathering dust. It rehypothecates it. It takes those same securities the hedge fund just pledged and uses them as collateral to borrow money from somewhere else. Maybe another bank. Maybe in the repo market. And guess what that borrowed money often gets used for? To fund more loans to more hedge funds who pledge more collateral, which gets rehypothecated again. You can already see the shape of this thing. It's not a straight line, it's a loop, feeding on itself. And why would anyone agree to this? Because it's genuinely useful, at least when everything's working. Rehypothecation is one of the reasons prime brokers can offer hedge funds cheaper financing. The bank isn't just sitting on dead collateral, it's putting it to work. And some of that value gets passed back to the client in the form of lower borrowing costs. It also pumps liquidity into the broader financial system. Assets that would otherwise be frozen in one place get to circulate and support multiple transactions. In a sense, it's like a multiplier effect for money and securities. One pile of collateral can end up supporting several layers of borrowing across the system. Economists sometimes talk about this as part of the shadow banking system. All this lending and borrowing happening outside the traditional, tightly regulated banking world, using securities instead of cash deposits. Now here's a detail that matters a lot for our story, and it's the kind of thing that sounds boring but is actually the whole plot twist. In the United States, rehypothecation is capped. Under U.S. rules, a broker can only rehypothecate up to 140% of what a client actually owes them. So if you owe your broker $100, they can only reuse up to $140 worth of your collateral. There's a ceiling. It's not unlimited. But across the Atlantic and in the United Kingdom, there was no such cap. None. A UK-regulated entity could rehypothecate essentially all of a client's collateral, sometimes even more than the value of what the client owed, depending on the contract terms. And because of that difference, something interesting started happening before the crisis. Big financial institutions began routing more and more of their prime brokerage business through their London operations, specifically because London let them offer clients more leverage, more borrowing power, precisely because there was no ceiling on how much collateral could be recycled. Lehman Brothers understood this perfectly. Its London arm, called Lehman Brothers International Europe, became a magnet for exactly this kind of business. So think about what was quietly building up here. Hundreds of hedge funds, many of them fairly large and sophisticated, chose to move their prime brokerage relationships to Lehman's UK entity, sometimes specifically because they could get more attractive financing terms there than they could get from a US-regulated broker bound by that 140% cap. They pledged their securities. Lehman's London operation took those securities and rehypothecated them, again and again, funding its own trading positions, its own borrowing, its own balance sheet. Layer upon layer of claims stacked on top of what was, underneath it all, the same finite pool of actual assets. Nobody thought too hard about what would happen if the music stopped, because nobody seriously believed a major global investment bank could just collapse overnight. That's actually a really important point, and it's almost more human psychology than finance. There was this baseline assumption running through the whole system that a firm the size of Lehman was simply too big, too central, too embedded in everything to be allowed to fail. So the risks of rehypothecation, what happens to your collateral if the middleman goes bankrupt, just weren't taken very seriously. It was treated as an operational detail, not an existential threat. And then September 2008 happened. Lehman Brothers filed for the largest bankruptcy in US history. And almost instantly, its UK arm, Lehman Brothers International Europe, was placed into administration. In plain English, the firm froze. All of it. Every account, every trade in progress, every pile of collateral sitting there. Locked. And this is where the rehypothecation story stops being an abstract economics lesson and turns into a genuine nightmare for a lot of very real hedge funds. Somewhere around $40 billion worth of hedge fund assets got frozen as a direct result of Lehman's collapse. Of that enormous pile, something like $22 billion had already been rehypothecated, meaning it wasn't just sitting there waiting to be handed back. It had already been repledged, reused, tangled up in other obligations elsewhere in the system. Some of it had genuinely been lent out to other parties, and at least for a good while, nobody could even locate exactly where it had gone. Try to sit with what that actually meant for the people affected. You're a hedge fund manager. You had pledged securities to Lehman's London desk as collateral for financing. You assumed, reasonably, that this was still fundamentally your property, just being used as backing for a loan. Then Lehman collapses and you discover that legally, once your collateral gets rehypothecated, you don't necessarily keep a straightforward ownership claim on it anymore. Instead, you often become something much less comfortable, an unsecured creditor. You're standing in a very long line behind other creditors, waiting to see how much of your own money you might eventually get back, if any. Meanwhile, funds you were counting on for your own investors were just gone, locked up in a bankruptcy proceeding that would take years, in some cases well over a decade, to sort out. Some hedge funds genuinely could not get their assets moved to a new broker in time. Some ran into serious trouble meeting their own redemption requests to their investors because the money they thought was available was frozen inside Lehman's collapse. A few funds didn't survive the shock at all. And keep in mind, this wasn't happening in isolation. This was happening in the middle of the worst financial panic in generations, when everyone everywhere was already scrambling for cash and trying to figure out who else might be about to go under. What made this particular mess so painful wasn't just the size of the numbers. It was the tangled, almost invisible web that rehypothecation had created. Normally, if you know exactly who owes what to whom, working through a bankruptcy is at least straightforward, even if it's slow. But with collateral that had been rehypothecated multiple times, sometimes across different countries with different legal systems, tracing the actual chain of ownership became a genuinely enormous forensic and legal puzzle. Administrators had to piece together who originally posted which securities, what had been done with them since, who else might have a competing claim, and how UK law versus US law treated all of it differently. It's a bit like that bicycle example from the start, except now imagine trying to sort out, years later, exactly who has a legitimate claim to it, using nothing but paperwork across two different legal jurisdictions, while several of the original people involved have also gone out of business. Now, here's a genuinely fascinating postscript to this whole saga, and it's the kind of detail that rarely makes it into the popular retelling of the 2008 crisis. Lehman's UK administration didn't just drag on for a few years and quietly fade away. It dragged on for roughly 17 years. 17. The team of administrators, led by accountants at PricewaterhouseCoopers, spent almost 2 decades untangling this web, chasing down assets, settling disputes with Lehman's other global entities, and slowly paying creditors back. And remarkably, by the time it finally wound down, creditors ended up being paid back essentially in full, plus statutory interest on top. Something that looked, in the panicked days of 2008, like it might turn into a total wipeout for a lot of people, eventually turned into one of the more surprising recovery stories in financial history. Just an incredibly slow, expensive, and complicated one to get there. But don't let that relatively happy ending erase the actual lesson here, because the pain in between was very real for the people who lived through it, and the systemic risk was very real too. Because think about what rehypothecation actually does to a financial system when it's used aggressively. It creates leverage on top of leverage. The same underlying pool of securities ends up quietly supporting multiple layers of borrowing simultaneously. When everything is calm and every institution is solvent, this looks like efficient, well-oiled machinery, generating extra liquidity and cheaper financing for everyone involved. But the moment one significant link in that chain breaks, the fragility of the whole structure becomes obvious almost instantly. It's not really that different from a game of musical chairs where way more people are playing than there are chairs available. Except here, most of the players didn't even realize how many other people were sitting on the same chair as them. After Lehman, the financial industry didn't exactly abandon rehypothecation. It's still very much part of how prime brokerage works today. But the appetite for it changed noticeably. Many large hedge funds started pushing back much harder in their negotiations with prime brokers, insisting on tighter limits on how much of their collateral could be rehypothecated, even in places like the UK, where there was no legal requirement to do so. A lot of funds began demanding that a bigger portion of their assets be held in properly segregated accounts, meaning accounts the prime broker genuinely cannot touch or reuse at all. And an entire industry shift happened around what's now often called the multi-prime model, where hedge funds deliberately spread their business across 2 or more prime brokers instead of concentrating everything with just one. Specifically so that if one broker ever ran into serious trouble again, they wouldn't have all of their assets trapped in a single collapsing entity. So when you zoom back out and look at the whole arc of this story, what you're really looking at is a pretty timeless lesson dressed up in some fairly technical language. A financial tool that seems perfectly reasonable and even beneficial in isolation, reusing collateral to unlock more liquidity and cheaper borrowing, can quietly stack risk on top of risk when it's done at scale, across borders, with weaker rules in some places than others, and with almost everyone assuming the biggest player in the chain is simply too important to ever actually fail. Lehman Brothers proved that assumption wrong in the most expensive way imaginable, and thousands of hedge fund investors spent years, in some cases close to 2 decades, finding out exactly how far that one assumption had let a mountain of promises get built on top of a much smaller pile of actual physical collateral.